Hi there everybody and welcome back to another stock analysis video. Today we are going to be analyzing the company Hasbro. This company, guys, has a lot of brands that honestly I didn't even realize they had. Obviously I know that they had the Hasbro Gaming and Monopoly, that kind of stuff, but My Little Pony and Beyblade, was not expecting that. Nonetheless, this company's earnings are coming out as of April 19th, so let's actually analyze their fundamentals to see if maybe we would like to buy this company at the current share price. So with that said, let's get started with this analysis. We are going to start off with, of course, the dividend summary. This company does pay a dividend at around 3.29%, which is actually pretty good, which ends up being 70 cents per share for an annual payout of $2.80. It's very, very good. Now, in regards to the payout ratio, in regards to the net income, this is looking at 52.11%, which is personally a little bit high. However, we do not want to see a company's payout ratio in regards to the net income. We want to see a company's payout ratio in regards to the free cash flow, because companies use the free cash flow in order to pay out their dividends. So we're going to take a look at that in the calculator in just 1 second. The 5-year growth rate on this dividend is almost at 6%, which it could be better, but it could be worse. 6% isn't that bad. However, something that is concerning is that they have not grown this dividend at all consecutively. In fact, the dividend growth is 0 years. However, if we actually take a look at the dividend history, looking at the 10-year, we can actually see as to why they actually have this consecutive dividend growth at 0. It's not because they cut it, it's because, well, because of 2020, because of the whole entire COVID situation, well, they didn't increase it up until 2022. So as it stands when it comes to a dividend play, this to me isn't really a big issue. However, it is still concerning because they could not afford to increase it even during a downturn like we had in 2020. Ex-dividend date, guys, is coming up as of April 29th. Payout date is May 16th. And of course, they pay their dividends quarterly. Now coming over here to the calculator, we got the ticker symbol of HAS, market cap of $11.6 billion, PE of 24.7. So just based off of the PE alone, just based off of the earnings, the current share price of $83.53, this is pretty much just telling me that this is a little bit expensive as it is. However, let's take a look at other metrics to come up with an even more accurate representation of what target prices we would like to buy it at in accordance to their shares outstanding and their free cash flow. As we just saw, guys, they do pay an annual dividends of $2.80. This comes out to be almost $387 million being paid out in dividends every single year. Now, in regards to the average 5-year free cash flow, we see that after this is paid, they're only left with $212 million left in the free cash flow, which in regards to a payout ratio is actually almost 65% at 64.61% as a payout ratio in regards to the free cash flow, which is actually really, really high. I personally like to buy anything under 60. Right now, this is looking like they cannot afford to increase this dividend. In fact, we actually saw in their dividend history that because they went through a downturn, they didn't increase it. This is a very, very big red flag, at least when it comes to a dividend play. Looking at the fundamentals, starting off with, of course, the net income 5 years ago of $397 million to 1 year ago of $428 million. Now, as it stands, this is an increase of 8%. However, if you just take a look at this graph, 5 years ago, $396 million, 4 years ago, $220 million, 3 years ago, way up to $520.5 million, then 2 years ago, because of COVID, you would expect them to come down. They went all the way down to $222.5 million, and then 1 year ago, 428. So as it stands, guys, this is pretty much all over the place. It's like a kangaroo jumping right here. It is an increase in the 5-year, however, this is not consistent enough for me to actually be excited about. Now we got the free cash flow, the lifeblood of the company. Cash from operations less your capital expenditures. 5 years ago of $589.5 million to 1 year ago of $685 million. That's an increase of 16% with an average 5-year free cash flow of almost $599 million. Now, as it stands, this is actually very, very interesting because we kind of see an inverse of what we just saw with the net income. 4 years ago, they went down just like we saw with the net income. However, if we actually see at the 2-year ago mark when COVID actually happened, their free cash flow actually increased, even that higher than that of 5 years ago, which is very, very surprising. And last year, they actually did less cash flow than the previous year when they had COVID. This is, again, something very, very concerning and kind of anomalous to be, in fact. So it is what it is. Me personally, again, it's not consistent enough for me to actually be excited about. Looking now at the revenue, we got 5 years ago of $5.2 billion to 1 year ago of $6.4 billion. That is an increase of 23.24%. This is looking a little bit more consistent than that of the other two metrics. However, from 5 years ago to 4 years ago, they went down, and then from 4 years ago onward is when they actually started to go up. So a little bit more consistent, but nonetheless, it is still not something that is jaw-dropping for me. Looking at the total assets minus the total liabilities, this metric pretty much simulates if the company were to liquidate all of their assets, would they be able to A, cover their liabilities, and B, how much money would they have left? And as you can see right here, very, very surprising, honestly. This is actually very, very surprising because, well, even though currently they are able to cover their liabilities with $1.3 billion left after their assets are being sold, they have been roughly around the same mark at the 1.4, 1.5, $1.3 billion for assets and liabilities. However, if you take a look at the 3 years ago, they shot up all the way up to $5.5 billion. What caused this? I have no idea. Something to take a look at more in depth. Now, average total assets, it's around $4 billion. Average total liabilities around $1.8 billion. And doing the average assets minus the average liabilities, we get $2.3 billion. Now let's take a look at the shares outstanding, a metric that people tend not to understand or even don't know that it exists. This tells you whether or not the company is diluting you as the investor. If you hold a piece of a company and the company decides to issue shares, well, your value as the investor, assuming that you don't buy any more shares, goes down because they just issued more shares, right? Supply and demand. If you have more of something available to you, that value of that something actually comes down. Same principles apply. 5 years ago of 124.4 million shares to today, guys, of 138.2 million shares. That is an increase in the 5 year of 11.09%. And from the previous year to the current year, so we're looking at 2 years ago to 1 year ago, it is an increase of 2/3%. This is again very, very surprising. I was not expecting this, and it's not like they just increased it after COVID. We've seen that they've increased it even before then, right? From 5 years ago to 4 years ago, it was 124 to 126. Then from 4 years ago to 3 years ago, 126 to 137. And then from 3 years ago to 2 years ago, from 136.9 to 137.3, and so on and so on and so on. They are diluting you pretty much every single year. And lastly, we got the cash equivalents. And the reason why we take a look at this is because we need to know how much cash they have on hand, so that way we can adjust the target share prices in regards to their debt. So currently, they have $983 million in cash equivalents with an average cash equivalents of $1.8 billion. And actually, I just realized this. If you take a look at this graph, you can see the same anomalous situation that we just saw with the total assets minus total liabilities, whereas 3 years ago, their assets superseded their liabilities by a significant amount. And we see the exact same thing in the cash equivalents, where they significantly have way more cash equivalents 3 years ago than any other year. Now let's come over here and make 3 assumptions, low, medium, high, and using 3 different factors: revenue growth, projected share buyback, and the required rate of return. For my revenue growth, guys, I'm going to be using Seeking Alpha's revenue growth tab, where if you go in there, you see the revenue growth year over year and the revenue growth forward. I like to make a conservative assumption between those two. For the projected share buyback, guys, I like to use the shares outstanding graph that we just saw. And for the required rate of return, I'm going to use 10% to match the S&P 500 on the best years. Now, for my lowest assumption, let's just say a growth of 6%, projected share buyback of -7. This means that they're going to issue shares at -7% within the next 4 years. This comes out to be a target share price of $86.90. For my media assumption, let's assume a growth of 8%, projected share buyback of -5%. So they're going to still issue shares, just not at 7%, a little bit lower. This comes out to be $94.86. And lastly, for my highest assumption, I'm going to assume a growth of 10%, projected share buyback of -3%. This comes out to be, guys, $103.46. Now let's figure out the target share prices adjusting for debt. And the way we do this is we take the cash equivalents, which is why we take a look at that, and we add the net debt. If a company has more net debt than cash, then this value comes down, and if they have more cash than debt, then this value comes up. As you can see right here, it does come down a significant amount. For my lowest assumption, it is $65.17. For my median assumption, it is $72.70, and for my highest assumption, it is $80.86. Now adding a margin of safety of 5, 10, and 15%, I would personally like to buy this at $55.39 all the way up to almost $62 for my lowest assumption. For my median assumption, I would like to buy between $61.80 to all the way up to $69. And lastly, for my highest assumption, I would like to buy between $68.73 to $76.82. Guys, the current share price is 83. So if you just take a look at this, well, as it stands, aside from essentially, if you're just not even taking into account the debt, this is looking like a pretty good buy. However, if you guys take a look at their net debt and their cash and equivalents, well, to be fair, they do have a lot more debt than cash. So in my personal opinion, I would just look at these numbers, right? But again, it really is up to you. If you just take a look at the target share prices after debt and of course the margins of safety, then you would still want to wait a little bit longer for you to buy this, because the closest one that we had, it is actually on my highest assumption for $80.86. But as I always say in every single video, guys, this is my assumptions. All these numbers, including the required rate of return, are just my assumptions. I have this calculator available for free. Anybody can have it. That way, you guys can make your own assumptions. Just go to my discounted free cash flow calculator videos. There's a playlist just called the calculators, where you can find this calculator, the book value calculator, and I also have there my dividend tracking sheet. So if you want to see that, make sure you see those videos and see on how to use them. Nonetheless, this is not financial advice. It never is. You guys should make your own assumption to see where your numbers actually lie. All I'm asking for in return, guys, for this free calculator, in fact, 2 different calculators and a dividend tracking sheet, is just 30 seconds of your time to hit that like button, hit that bell, hit that subscribe, and of course, tell your friends if they would like to find a way to invest that is through a fundamental basis. Then I think my channel will be pretty decent. In fact, I'm giving out these things for free. All I'm asking for in return, guys, is, of course, like, subscribe, comment. It really does help. Now let's take a look at the dividends at the current share price. If we were to take the average US income, which is $68,703, and bring it to the monthly, which is $5,725, if you were to put in 1 month's income into this company at the current dividends per share annually at $2.80, how much money would you get in dividends annually, quarterly, and monthly? Well, if you were to do so, this would buy you 68.54 shares, which would come out to be $191.92 in annual dividends, $47.98 in quarterly dividends, and almost $16 in monthly dividends. So as it stands, this isn't necessarily that good. There are other companies that pay significantly more and that are even better value than this one as it stands. So when it comes to dividend play, in my personal opinion, there are better ones. All in all, when it comes to a company like Hasbro, honestly, it is very, very underwhelming. With a PE of 24, their metrics aren't that good. At least in my opinion, they're not that good. Sure, they're in the positives, I guess, but they're not consistently positive. They're not consistently growing. They are issuing shares like crazy at almost 12%. So as it stands, this doesn't really fit my investing strategy. Even though they do pay a dividend, I would personally like to look for something with a little bit more value. That pretty much does it for this video, guys. Like if you like, comment, subscribe. As I said, you guys can follow me on my new tech site at BitChute, Odyssey, and Rumble. If you want to see my Let's Play channel, link in the description below. I'm currently playing Sonic Unleashed, so if you want to follow me, you can follow me there. With that said, peace out, and of course, be on the lookout for the next stock analysis video.